Welcome all of you to the Qsigma. In the previous video, I explained about the logic behind this algorithm. In this video, I'm going to give every detail that you needed to trade from the system. How we enter the trade, how we're going to exit the trade, and how we position size the trade, and what is the money management that we are going to use here. Everything that you need to go for live, I'm explaining today. From after this video, you will be able to trade from your own. As I mentioned every time, this algorithm is a semi-automated algorithm. It means the execution part is on you, the analysis part is on computer, the algorithm. This algorithm analyzes the hard part for you, because then you need not to be here every day. Because if you get any alert, let's say example, you get this alert will be notified to your phone, to your email, or even from your personal computer with the sound alert. So that's very beautiful part. Then you need to watch the trade, see the trade. If every rules meet, you can just go for the trade. That's very simple. And this is the trade that today came, and it's very simple. Only 1-2 trades, because we don't we are not going to trade every alerts, because I'll later explain about how we're going to use it. Simply the entry part, how we're going to execute a trade. Very simple. If you see blue dots, it means buy the market. If you see red dots, it means sell the market. If you have a blue alert, it means go for longs. If you have red alerts, it means go for shorts. Very simple. Okay. With the execution, with entry market, every time you need a stop loss. And with the entry and the stop loss, we need a position sizing. It means every time how much we are going to risk. We never ever risk more than 0.5% for one trade, and we are running 4 trades with the 2% of risk. And never ever, okay, I'll explain later on those things, because this is somewhat be complex for you. Okay, so when you enter in the trade, you can risk 0.5% or 1% or even 2%. It depends on you. But we are not recommending never ever risk more than 2% from total portfolio. It means if you risk this trade for 0.5%, you can run 4 trades in the same time with separate currency pairs, because we never ever trade 2 trades in the same currency pair. If you use 4 trades, you need to have 4 currency pairs. But if you risk each trade 0.5%, you can run 4 trades. That will equal to 2% of your portfolio risk. We never exceed the 2%. If you use 1% risk for each trade, you can only trade two trades from 2 currency pairs. It's depend on you. Most of the time we are risking 0.5% for the trade, and we are trying to catch 4 trades and with the 2% maximum risk. Why we use 4 trades is to diversify the portfolio with non-correlated currency pairs. Okay, that's all about the position sizing. If you enter for the market, you keep the sell, and this losing money, you can position size up to 2%. Our recommendation is to risk 0.5% per trade. I'll tell you again. If you enter for the trade, place the sell and make the position size to 0.5% or 1%. That's it. Okay. Then how much pips you need to place for the sell? It's very simple. If you use we use two types of trades, placing trades. One way is dynamic SL positioning and other one is the static. Now I'm going to give you a static way of trading. If you enter for the market, our recommendation is to keep 30 pips. Our SL is always 30 pips. 30 pips from the entry. 30 pips. Because our analysis shows that 30 pips is the perfect SL for this type of day trading charts, because we are using 15-minute time frame. That's why we use 30 pips. For the GBP crosses, sometimes we will change the stop loss pips amount, but most of the time other currency pairs we using euro 30 pip stop loss. For 30 pips, you can only risk 0.5% or 1% or 2%. You cannot exceed that. If you use 2%, you can run only this trade to hold your portfolio. If you use 0.5% for this trade, you can run 4 trades for your whole portfolio. It's very simple. Okay, let's go for the trade. Say this is in this phase your market is changing to bullish. It means, as from the previous video, you know about the Qsigma trend. Qsigma trend determines the trend. Now it's bullish, so market is bullish. Current trend is bullish. Okay. Let's say that you enter from these days. Let's try to do. What is happening is, let's go. A little bit zoom up. I use the trade, I enter for the trade, and I use 30 pips. 30 pips here. Okay, now 30 pips. What happened? What happened to this trade? I enter from this trade here, and I use 30 pips stop loss, and I use 0.5% risk. 0.5% risk, and the trade continues come and hit our stop loss. So we are minus 0.5% from now. Okay, it's okay. Then we have no any trade. And other thing is, in here you see that you are running a trade at here. Now you get another trade alert. This is the first alert, this is the second alert, this is the third alert. In the second and third alert, your trade is still running, but you cannot enter for this trade. Because why? Your first trade is still running. If you enter for a one trade, you cannot enter for any other signals from the same currency pair. So you cannot trade 2 and third alert. You can only trade the first because it's still running. If this close by a stop loss or profit, then only you can enter. Okay. Then this trade close here. Then we have another entry signal from this. And we use this stop loss as the same static way, 30 pips. 30 pips. Okay, 30 pips. What happened here is, we enter for the trade and we go, and now we reach R1 and R2, 1 to 2 risk reward. And what happened is, you get, this is the first alert, and you get the second alert. Can you enter for the trade? No. If the first trade is still running, you will never able to enter for the second trade. Can you enter for the third trade? No. If the first trade is still running, you cannot enter for the third trade. I think you can understand. If this is running, you cannot enter for the trade. You want to still run it. Okay. Now we know if this goes down, we can stop by the stop loss. But when we profiting, what we can do? Where are we going to exit? Because that exit gives us the profit. Okay. Our algorithm comes with the inbuilt exit strategy. I'm going to make it activate. You can see, if you are in a bullish market, your exit strategy is giving red crosses. Red crosses. your exit strategy is giving red crosses, red crosses, red crosses. These red crosses represent the market slowdown areas, counter areas. So you enter for the trade here and you keep it running, and what happen is that your first exit is LRDs come by here. You have two ways to do this. You can exit partially. You can exit 50% of your trade and keep it run, and if you get another exit, you can 100% get out. This is one way, okay? Or you can exit simply 100% from the here. Then you will earn about 3 times of your risk. That's a good risk reward. And there's another last way is, if you trade like this way, say that your stop loss is here. If the market reaches here R1, you have to drag your stop loss to here and make the trade break even. Then if the trade is reach R2 level, then you have to do is you have to again drag the stop loss and break even the R1. Then what happen is, then our market reaching here and we are going to exit in here. Then how much we get? We are getting only R1. If you use the fourth way, it means the way of the with the money management way exit, you getting R1. If you use inbuilt exit system, you getting the R3. If you use a partial exit, you getting more than that too. But it depends on the market structure and market conditions. Sometimes this way, stop loss drag money management way is more profitable than our inbuilt exit. Sometimes our inbuilt exit is more profitable than the money management exit method. It depends on the market condition and the structure, but don't worry, stick to one. If you need to use inbuilt exit, stick to that. But we are not much recommending that, because if you use our exit, inbuilt exit, that's a quantitative analysis, you need some special skill sets, because we are using a portfolio analysis and some recovery management too, to make more profits. It means to maximize our gains. But we are not going to explain everything in detail, more complex way, because it's not it will not clear for you, because it will make you complex more. But because we are unhappy to do that, because sometimes you can be bored from that. Okay, now I told you how to exit when you profit in the trade, and I show you several ways. Okay, it's okay. Let's go for the another trade. So if you use a money management way, you are exiting in here. If you use inbuilt system, you exiting in here. If you partially exiting, you exit in here. Okay, now this cycle is closed because you exit the trade. You never get into these trades because this trade is running. Okay, that's it. And what happen is, and remember, if you risk 1% to this trade, if you use money management, you are gaining a 1%. If you exit in our inbuilt exit, you are gaining 3% from 1%. Okay, that's the way position size is. Never ever risk more than 2%. Most we are risking 0.5% to 1% only. That's the position size. Okay, now we are getting another trading signal right here, and we place the stop loss as usual 30 pips. Okay, 30 pips. Now trade is running. I'll show you our exit method. You will get the exit. Then what we do, we exit the trade. We are gaining about, if you risk 1%, we are gaining about 1.5%. Okay, that's if that exit is if you exit from our inbuilt system. Let's say that if you use money management system, what will happen? If you use money management system, what will happen is, you went for the R1, reached R1, then what will you do? You take the stop loss to here, then market is I'll show you. You reached R1, it means 30 pips. Then you get in the SL here break even from here, and market is still going up. Then you reach the what, R2. Then what you do, you grab the SL to here, it mean here. Okay, sometimes you are confused with the time. I'll give you like this way. The market is going R1, then you move the SL here, then here it reaches R2, then you are moving the SL to here. Then what happened, market comes down and you exit in here with the R1. If you use a money management way of exiting, you are gaining about 1%. If you use our inbuilt exit system, you are gaining about 1.5%. If you use money management, you're gaining about 1%. Money management system way of exit. Okay, then anyhow your trade is closed by here with the our exit or using the money management level exit. The cycle is over. Okay, then today, now this is the most recent example. This is the today market. You get the today trade here, and I get the stop loss as 30 pips right here. What happened is, you are getting first exit in here from our system. It means it's about 1.4%. if you risk 1%, you are gaining about 1.4% from this exit. If you use money management, system, you are placing the SL. So now can you enter this trade? No, because your first trade is running, so you cannot enter this trade. Your trade is running, you reach the R1 level, then what you're doing is you keep the SL here, and now it reached the R2 level, you keep the SL here. Then what happened is, now your exit is here. So in the money management level, you gaining about 1% if you risk 1%. If you use our risk system, it will gain about 1.4 to 3%. Okay, it's okay. Anyhow, today's cycle is closed, because why? We enter for the trade and go for the exit, or this exit, we just go out to the market. I'll give you a little summary. We are losing here about, let's say we risk every trade 1%, we are losing 1%, and I use our inbuilt exit, we are gaining about 3%, and here our system, we are gaining about 1.5%. in here, this is I use 1.3%. so we lose 1%, and it means here 2% plus 1.5%, 3.5%, 3.5% plus 1, 4%, 5, 4%, 8. In this bullish market, we are able to gain about 4.8% if we risk 1% for each trade. That's really good. And we used static SL. It means we use 30 pip SL. And sometimes dynamic way, I'll give you another example, the advanced way of trading. So this is the system. You are using 30 pips stop loss for the trading. You are using 30 pips stop for the trading, and not for the sometimes for the GBP process you can be changed, you can be wide your SL because of the ATR, but most of the time we use 30 pip SL. And if you are in a trade, you cannot enter for another alert. If you're going to exit within our inbuilt exit system, it's okay, nothing to worry about. And if you use money management level, you need to simply go to the SL and make the trailing stop to 30 pips. Then it's okay. The level way exit is activating. So two types of exits. You can just enter for the trade, position size the trade, use the 30 pip stop loss, 30 pip stop loss, and you can risk 0.5% or 1%, but not maximum than 2%. And if you exit from our inbuilt system, it's okay, nothing to worry about. If you use a level way of exit, you need to right click the stop loss and make the trailing stop to 30 pips. So this is the simple way to trade. These are the simple entry and exit rules that we are, and position size and money management, everything. If you get any other questions, you can post, you can just write me and do anything. Whenever, from which you contact, I don't mind. You can contact me anywhere. Then if you have another questions, I'll give you more videos to explain that you do not understand parts. Later I'll give you some other advanced explanations to these things also. This is the simple explanation how you enter for the market. This is the market. You can see we can have plenty of trades, and we have plenty of stop losses and exit signals. You can see you can this is what I'm explaining, but now you are able to watch by yourself, because you can download the algorithm and use the template. I have two templates, with the exit and without my exit. First use the without my exit, because that will clear you the entry part. Then use the exit, that will clear you the exit part. You make the experiment, and if you need any assistance, we are here to help you, because we are doing every day this one. And this is our one of algorithm from our portfolio. Enjoy. If you have any problem, just post us. Thank you.